Welcome to Global Money Talk, brought to you by Sunpro TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and joining us today is Dan Ha, partner at Karani Asset Management. Dan, welcome to the show.
Thank you. Glad to be back.
Good to have you. So today, we've had, we're getting late in December.
Yeah.
We have pretty much all the important data out this month that's going to be on. We only have the Fed meeting left. So, what are your thoughts on the equity markets here? We've had a big rally since the election, maybe stalled out a little bit, but now a little uneven. What are you thinking?
So this past week, I've been seeing a lot of discussion around the breadth of the market. And what that means is, how broadly are stocks moving together or, participating in an up market or in a down market for that matter. And the opposite would be a narrow market, a concentrated market. And the breadth of the market has not been so great this past week. It's, so far been a slightly, sort of a flattish week. Nevertheless, we're seeing more sort of a narrower market in terms of participation, which is not in and of itself, it's not good, but in and of itself, it's too hard to know whether that's, bullish or bearish. We all wish for there to be a single metric that we all could look at and say, oh, this indicator says bearish, must be bearish. This indicator says bullish, must be bullish. So you can't just look at one, but breadth is usually something that sort of points to the overall health of the market, because you want sort of broad participation, and it's a more usually seen as a more sustainable kind of a market when the breadth is wide. Having said that, the reason why that to me is interesting is because it's only a couple of months ago when the theme in the market was broadening rally, sort of everything else rally. The participation of, it was time for the S&P 493 to finally go up. It was time for the small caps, the 2,000, the smaller 2,000 companies to finally participate in the rally. And it looked like that was happening for a while, but suddenly, this week, we had sort of the larger caps lead again. So what that tells me is, sentiment in the market could change really quickly. Another interesting thing that I've been seeing a lot is, I've been hearing a lot of people come on TV and come on media and talk about software over semis, that they're bullish on software and bearish on semis. It was only again a few months ago when people were talking about potentially this death of software, because Gen AI was going to make a lot of these software companies irrelevant. And suddenly, just 2-3 months out, we're now, people are now more optimistic on software over semis, because software stocks, quite frankly, have been doing better. I actually brought some charts, probably better to talk with some charts. If we could show slide number 1. So while we wait for that, there we go. So this is a chart of software versus semis in the first half of the year, total return. So the orange line is the semiconductor index, and the white line is the software index. First half of the year, clearly semiconductors way outperformed the software index, which is why, this is why people were talking about, oh, maybe it's over for software. But if you go to slide number 2, in the second half of the year, things reverse. So again, the white line is software and yellow line is semis. And we can see that the situation completely reversed. And so now people are more optimistic about software over semis. If we go to slide 3, slide 3 is Max 7 versus Tesla. Now, Max 7 includes Tesla, but earlier in the year, you often heard people talk about the Magnificent Six, because Tesla, a lot of people argue that Tesla really shouldn't be included in the Max 7. And as you can see, the Magnificent 7, including Tesla, way outperformed Tesla. So if we actually had a Magnificent 6 index, the gap would be even wider. If we go to the next slide, slide number 4, in the second half, the situation now completely reverses. Again, the orange line is Tesla and white is the Magnificent 7. Again, the Magnificent 7 includes Tesla, so if we exclude Tesla from that index, the performance differential would be even wider. And the last slide, slide number 5, this is the so far quarter to date. I mean, the quarter's almost over. Large cap versus small caps. It looked like for a while that the small cap trade was really outperforming the large caps. But as of yesterday, yes, small caps still outperforming the large caps, but not by that wide of a margin. I'm just pointing these out to say that narrative in the market could change really quickly. The sentiment could change really quickly. Therefore, I think what's really important for investors to always keep in mind, one of the most important principles in investing is to go where expectations are low. Because, again, when sentiment changes quickly, a lot of these low expectation stocks, like Tesla, for example, could reverse very quickly, and vice versa. Things that have high expectations built into the price could reverse very quickly too. So I think focusing on where low expectations are for long-term investors, I think is important to consider.
Would you say is this an argument for the periodic rebalancing of portfolios? If you want to rebalance so if you have stocks or parts of the portfolio that really outperformed, you want to lighten up on those and put that cash into parts of your portfolio that you like but you have underperformed. Would that be sort of an analog of what we're thinking about here?
Yeah, no, there are different schools of thoughts about that. Some people will say, you want to let your winners run. People will talk about how you gotta, don't get in the way of compounding. Things that have been working, basically, continue to hold on to them. Some people will argue that you probably should sort of periodically rebalance. I happen to be in the latter camp, and you can't really say which one's better. It has to. At some point on the show, I've talked about needing to find a strategy that really works for you, that puts you at peace. It's something that I learned from Howard Marks. And for me, I think periodic rebalancing is a more prudent approach. Now, also, but depending on whether you're a taxable individual or an entity versus tax exempt, the frequency of rebalance also matters. So if you're taxable, then you don't want to be rebalancing too frequently. Because even though doing so may serve you well in terms of returns, you may end up paying more in taxes if you're doing it too frequently. So that needs to be considered. But taking some profits off the table when prices reflect high expectations, and sort of rechanneling that money into sort of the more lower expectation parts of the market, I think is a prudent strategy.
Let's get back a little bit to, you were talking about some low expectations. It's a good place to invest.
Right.
Where are you seeing low expectations today as people are thinking about decisions, in the new year perhaps, or at the very end of the year?
Yeah. So two areas where we're finding lower expectations relative to a few months ago these days are one in healthcare, particularly in pharmaceuticals, and second in semiconductors, kind of broadly. there are obvious reasons. It's important to remember that when there are low expectations reflected in prices, usually there are obvious reasons why that reasons for that. There are, they say that markets climb a wall of worry. Basically, when the worry becomes the thing that investors worried about no longer becomes something that you no longer have to worry about, then that gets reflected in the price, and the prices go up. That's why it climbs a wall of worry. There are obvious reasons for these things to have low expectations. So, again, pharmaceuticals, as I've mentioned it on the show previously, we don't know what the new administration is going to do in terms of how they're going to approach drug approvals and governing, running the FDA, and that is a big sort of question mark for the industry, and investors usually don't like that. So some of these pharmaceutical companies clearly are reflecting, their prices are reflecting lower expectations relative to, say, pre-election. Semiconductors, similarly, there's obvious geopolitical risks. China has opened an investigation, antitrust investigation on Nvidia, for example. Personally, I think that's probably more likely, more sort of noise and just sort of political tactic, a chess move, if you will, rather than something really substantial. Nevertheless, geopolitical risks are real, and that's what gets reflected in the prices. But the thing is, with a lot of these, when you're looking for low expectation situations, one thing that you don't want to do is just naively catch falling knives. You could really get hurt trying to catch falling knives. And so you shouldn't just jump in just because something's down. There has to be a good fundamental basis for you to go and sort of buy it and use that as an attractive entry point. If you're going to be looking at low expectation situations, it's really important, I think, to focus on quality. Quality is a long-term investor's friend. When something is down a lot, if something is trading at really low multiple, but the business is, let's say, operating in a really challenged industry, a precarious company in a highly competitive industry, or a business that is not making much money or maybe even losing money. Those are the kinds of situations where you don't want to just say, oh, like low expectations, let's go buy in, because the risk of a permanent loss is really high in those kinds of situations. But a high quality company that's really selling mission critical, indispensable products, and for whatever reason it's out of favor temporarily, I think those could be sort of fertile grounds for you to find potentially attractive long-term opportunities. Because at the end of the day, if you're selling something that's indispensable or mission critical, something really important, sooner or later, the world's going to need your product again. And if we look into the semiconductor industry, there's a lot of question marks around the supply chain, the geopolitical risk, and also the cyclicality of the industry. But it's a lot of the companies involved, even though they may be going through even though they may go through cycles, and they will go through cycles, are selling products that you really need if you're going to produce semiconductors. You just can't do without. And so those sorts of situations, I do want to mention that last week, I think it was last week, we were talking about Intel and how in semiconductors, in particular, because it's a fast-changing industry that is also highly capital intensive. Yeah, if you make one bad decision on a product cycle, that could be detrimental. So in the semiconductor space, the other day, Google announced their new Willow quantum computing chip. Could that really bring a new paradigm shift to the semiconductor industry and even to the manufacturing processes involved. It's possible. It's technology. That risk is always there. But for now, the risk of some new manufacturing technology, paradigm-shifting technology just coming out of the left field to make the current supply chain obsolete, I think is pretty low. Therefore, we're finding some interesting opportunities in the supply chain.
So to borrow a little bit of a cliche, when they say they're throwing out the baby with the bathwater,
right,
you want
right.
to catch the baby and let the bathwater go.
Exactly.
And then when the market is so downtrodden, or a sector is so mood is so bad about it, there might be a good opportunity as long as they have a good or a service that's really actually very good,
yeah.
and they're getting sort of the drag down and the downdraft of everything else. I think
right.
that's very good advice.
Right.
I want to get a little bit more into this Google quantum computing
sure, yeah.
chip.
Yeah.
I mean, I saw the announcement was made, and then I was just looking at some reactions on Twitter or X, and so some like Geiger Capital said, well, you can spell the death of Bitcoin on that, and then there's a load of comments afterwards.
Right.
I mean, is this chip that's supposed to be able to do things that unimaginably quickly compared with normal chips?
Yeah.
Is it really that such a big deal for Google?
Yeah. So what we know so far is pretty remarkable, and based on that, it does look like it's a big deal. This quantum chip apparently did in under 5 minutes a calculation that would otherwise take 10 septillion years to do. 10 septillion is
really big number.
25 zeros. 25 zeros. Basically, physically impossible to do. But this quantum chip was able to do that in under 5 minutes. It's a big deal. It's such a big deal that don't take my word for it. Elon Musk commented on X. He said, "Wow," when he heard this news. So it is a big deal. What this means for Google in terms of potential revenue opportunities and what this revenues and profits, it's way too early, too hard to know. But I think what's really significant about this, because Google stock actually went up double digits over 2 days on this news. I've been on the show talking about Google as a attractive risk reward. Not an absolute you must buy, never will I say that, but it's an attractive risk. It was an attractive risk reward because my argument was that the innovation engine at Google is far from being over. It's still alive and well, and so this kind of was demonstrated that they actually have still industry-leading capabilities inside Google, and so if they could potentially develop that into successful products, it could change the future of the company. Clearly, the search business is under attack from Gen AI, OpenAI and ChatGPT and such, but the search business is still it's not dead by any means. It's still doing quite well, and this introduction of the Willow chip just proves that Google is really doing some cutting edge breakthrough research and development inside the company. So from that standpoint, to me that was the significance of the announcement of the event. What this means for the value of the company going forward, we'll have to see. But there is, one thing I do want to mention is, people talk about, sometimes it's helpful to think about investing from the opposite side. Sometimes we wonder at our firm, would we short Google? The answer is, the answer is no. Why? Because the core search business, all right, let's say that it comes under real intense attack, and let's say that they lose that business. That's a really bad scenario for Google, obviously. But they also have so many things going on. They have lots of shots on goal, and if some of these things it really takes off, it could potentially replace and even exceed the value of the search business. So take, for example, this is a pretty simplistic way to think about it, but sometimes it helps to think about it simplistically. Waymo. All indication is that Waymo is doing quite well. The autonomous driving technology of Waymo is really quite good. People are putting numbers, people are saying that Tesla's autonomous driving capability alone is like $1 trillion value capability. All right, so if Waymo is, the number 2, if Tesla is the Apple in the autonomous driving game, and if Waymo becomes the Android of the autonomous driving industry, then Waymo ought to be, if Tesla Autonomous is worth $1 trillion, then Google Waymo ought to be worth something in the in some sort in that neighborhood. Don't know how much exactly, but so there's one potential. This quantum computing chip, who knows how much it's going to be worth? But if it's such a big deal that it makes even the GPUs obsolete, and GPUs have made CPUs kind of obsolete in terms of AI compute. If quantum computing is going to make GPU obsolete, and NVIDIA is worth how many trillions of dollars? $3 trillion. And quantum computing chip could be worth just as much if that were to replace GPUs. I'm not saying that it will, but if you think about it that way, the search business of Google, you could see sell-side analyst estimates anywhere in the neighborhood of like $1 trillion and change value for the search business. If some of these businesses really develop successfully, it could be worth more than the search business. So even if the search business eventually in time go away and become a thing of yesterday, they have these other really promising businesses that could not only replace but even be worth more than that. So I would be really scared of that scenario if I were shorting Google just because I thought the search business was really under attack. So that's what I mean in terms, it's important to always think in terms of risk reward, and I think that's why the Willow chip announcement was so exciting, because it proved that no, Google's not dead, Alphabet's not dead. They're really doing their research and development engine is kind of live and well.
I think your point is really well taken. In terms of, I sometimes think of Google as the big gifted and talented camp, and a big gifted and talented camp with a good pipeline, or at least one very good item in the pipeline. This Willow chip suggests that they have other things going on in the background, other projects, and you may want to take some profit on it, but sure as heck may not want to short it.
Right.
Well,
right.
Thank you so much for coming on to the show and telling us a little bit about some of these sectors that are a little bit out of favor. Something certainly to think about as we wind up the year and look ahead to 2025. Great to have you on the show again.
Thank you very much.
And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SomPro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us. We'll be back here on Monday. Have a great weekend.